What's up, guys? Doug Polk here, and welcome back for another episode of the Doug Polk podcast. The podcast is finally back. I know we had a few weeks off. We were going to be joined by Rob Young, but unfortunately, he did end up with a bad case of the Rona, so he had to take a couple weeks off. Hope he is recovering. And it's been a couple weeks now since the podcast got going. We got a couple of exciting podcasts lined up for you in the near future. Today, we are joined by CEO of CoinFLEX, Mark Lamb, joins the podcast. Got a lot to talk about. I think we really kind of want to hone in on the recent situation with the crypto market, as well as the collapse of the stablecoin UST. A bit of old news now, but I think there were some really important topics to talk about when it comes to stablecoins and their role in crypto today. Next week, we're going to be joined by Eric Persson. You guys probably saw him from his heads-up match with Phil Hellmuth, so that should be an exciting one. He obviously owns a chain of casinos around the country and world, is my understanding. I'm not sure exactly how far-reaching that is, but definitely outspoken, and he will be joining us on the 20th. Looking forward to having him on as well. But before we get into today's guest, I want to let you know that, as you should already know by now, today's podcast is brought to you by CoinFLEX.us. CoinFLEX.us is the first regulated crypto exchange that offers all users zero trading fees. You can sign up in minutes and instantly start trading Bitcoin, Ethereum, and more with no fees. Head on over to CoinFLEX.us now to learn more. Legal disclaimer: none of the information contained here constitutes an offer to buy or sell any currency, product, or financial instrument, to make any investment, or to participate in any particular trading strategy. I now introduce today's guest, Mark. Welcome to the podcast, man.
Great to be here, man. Thanks.
Nice to finally get to actually meet you. We had a little event the other day, got to meet you and a lot of the CoinFLEX team. And then you guys even came down to the lodge.
Yeah, that was awesome. That was a really epic poker game, and really great to finally meet you in person. So
Likewise. I was a bit surprised by the size of the CoinFLEX team, not in number of people, but in actual just size. For some reason, I always pictured Kenny as a very small dude. I know obviously he's Asian, so I guess I just didn't. The guy's very large. Charlie large, big team.
Yeah, it's a big team numbers wise, and it's also a big team physically sometimes. Yeah.
The event that we had, when I got there, I was like, is this the right place? I'm not sure. And then I just saw you wandering around looking confused. So okay, I think I'm in the right place.
Great. Yeah.
Okay, so let's go ahead and let's jump into some topics that we've prepared here today. I guess, originally this was going to be a little more centrally themed around stablecoins, but I think given the state of what's happening in the market, we simply just kind of have to open with what's your macro view on the crypto markets at large today? And then I guess also what are the factors here that you think are playing a large role in the, let's be real, aggressive downward movement of crypto prices?
Yeah, I mean, it's really two things. And I know these get repeated a lot by people who talk about what's going on in crypto, but it is the truth. So it's worth repeating. Macro, basically, the most important price in the universe is not the price of Bitcoin, it's the price of money. So really interest rates, and the Federal Reserve controls those interest rates. And when they raise those interest rates, every investment becomes more expensive to finance. So if you want to leverage your investments, if you want to buy a house, buy stocks using leverage, that becomes more expensive to finance. And so generally speaking, like, it lowers the price of assets. And that happened yesterday. The Fed raised rates by almost 1%, 75 basis points, 0.75%, however you want to look at it. And, there's been this continuing of kind of the Fed looking to raise rates and probably raising rates into an economy which is strong, but has probably gotten speculatively overbought, and then now the stock market is kind of crashing as well. So that and right now, when in this market where there was free money that the Fed was sort of lending out to banks and other institutions at zero interest for long extended periods of time, everything kind of became related. So what I mean by that is crypto, housing, stocks, anything that was considered a risk asset became related to each other in price. So previously, when I got into Bitcoin, it wasn't related to the stock market. You'd have boom and bust cycles in Bitcoin, specific to Bitcoin, that had nothing to do with stocks. Now, because of the nature of the financial markets where the Fed is such an important factor, these things are super, super related. So crypto and stocks have both collapsed a bit. The difference this week and last week is, and the week before, is what happened with UST. And so UST drove a lot of very crypto specific liquidations and selling that basically went beyond just what was happening in the broader stock market. And those liquidations actually drove further liquidations, which caused, some big important firms in crypto to come into question as to whether they were solvent. And so when you have that type of situation, what happens is credit markets freeze up. And in crypto, there are a bunch of on-chain lending markets. There are also a bunch of private companies that will lend to institutions in crypto. And in both cases, but especially in the cases of the private ones, they basically stopped lending or stopped lending at the same terms that they were lending at. And so really the assumptions everyone had to make in terms of the availability of leverage and credit went out the window because these firms' solvency went into question. And this, this is kind of similar to what you have with Lehman and these types of things, where one institution starts having problems and then everyone's having problems. So that's kind of what we've seen in the last few weeks. And the question everyone's asking is, have the liquidations finished, or are there way more to come?
When we talk about UST and we talk about its role in the crash of this market, while that was certainly the early, one of the main early factors for what happened here, and then it sort of just spiraled because, and this is something we've seen time and time again in crypto, is that this is a hyper speculative asset class. And also when the market tends to rally extremely hard, and people tend to take on leverage and they start to go extremely long. And so when there is a downturn, people get liquidated, and then they're forced to sell assets to cover their liquidations, and it creates sort of this death spiral.
Yeah.
We've seen this time and time and time and time again. How much of it would you attribute to that sort of standardish series of events versus the solvency of some of these large firms? And when you're talking about their solvency, I think you're most specifically talking about Celsius and now a little bit of 3AC, the fund as well. Kind of rumors swirling about them too. What are there any other players that you think are important when we're looking at this? And how much would you say that those firms have played a role in this downturn?
Well, I think anytime you have any firm that is basically, the rumor is that, there are firms that aren't meeting margin calls. And anytime that's happening and you have to liquidate collateral, it's going to play a big role. Not even if the collateral is that meaningful. It could be $1 billion, but the market could totally handle $1 billion. But the issue is, it's $1 billion worth of collateral that can be sold at any price. So it has to be sold, quickly. The people and the institutions that are selling it in order to get as much back as they can from borrowers that they don't think are going to repay them anymore. Those people that are selling it are going to be indiscriminate in how they sell it. So they're going to sell it in ways where they don't care about slippage. They don't care about anything. And that's a dangerous scenario for the market, because in a time like this, it's also the time when selling it is the most difficult. Liquidity in boom times is really great. You can buy $1 billion worth of something, sell $1 billion worth of something, no problem. But in a time like this, it becomes very difficult to get the same size in or out. Well, especially out sold. So that's the issue, really. I think these types of liquidations also have another effect, which is that they cause fear. So even if that $1 billion gets sold, or however many billions of dollars gets sold, it also makes everyone think, oh, wait, who else might not be solvent? Who else might not be all there? And that's when you start to get speculation, and people's imaginations are what cause bull markets. They're also what exacerbate bear markets, and they're also what protracts bear markets. So, I was talking to someone today about how long this might be, and it could easily be 2 or 3 years of a bear market, because at the end of the day, people have wild imaginations. So when those wild imaginations are to the upside, they're thinking about how amazing everything could be and how incredible it could be. But when they're to the downside, they're really thinking about, wow, maybe everyone in crypto, every single trading firm, every single lending firm, every single exchange is broke. And that's obviously silly. Like, there's a lot of extremely profitable businesses in crypto, very safe, well risk managed businesses, trading firms, etc. So that's a silly proposition. But again, I mean, in the bull market, those are the same type of people that probably thought Bitcoin was going to go to like 500K by the end of this year, or something like that. So these types of mentalities get very extreme in both directions, and that's why you have protracted long moves.
Do you want to make any specific comments regarding the Celsius freeze on payments? Your thought on what happened there, and or the 3AC apparently withdrawing funds from trading accounts? Do you care to comment on either of those different incidents?
Probably not those specific firms, just because we don't talk about any customer relationships or customer that people that might be customers of ours, and so I can't make a comment on that. It's not something that CoinFLEX has any exposure to. We have no exposure to any of the firms where solvency is under question. None of these players have leverage on CoinFLEX or exposure on CoinFLEX. So I can't really make a comment on how they're specifically doing. I do, generally speaking, I wish everyone the best, and I want crypto to succeed. We're all going to succeed together. Some of us aren't going to get there. Some of us are going to go by the wayside.
We're not all going to make it.
Yeah, I mean, it's unfortunate. We're not all going to make it. Like, there will be firms that blow up, and that's really unfortunate. But I do wish everyone the best, and I wish Celsius the best, and I wish 3Rs the best. And it's a very difficult time, and yeah, it's the sort of thing that, who knows? We'll see what ends up happening. But it's these market conditions are very, very unlike other bear markets because of how much leverage is in this market at this point. So, and it's still not as much leverage as there could be, but it's a lot more than we've ever had. So,
How are end users and investors supposed to be able to discern the legitimacy of these various companies? Because if we're talking about two of the bigger names in the space that are having some kind of solvency issue and we're not able to pay out. So when we think about this on the end user, from the end user's perspective, what are some of the characteristics of a company that you should be looking for where you think, hey, I can trust these guys, and I think they're going to be responsible? Because I think we're getting to a point now when we see players this large, this kind of thing happen. It's not just your name is big, and so you're too big to fail, or you're simply, just because you're a huge entity, you can't make mistakes.
yeah.
Obviously, we go back to the start of all of this. We think of Mt. Gox, right? They were the big player for Bitcoin trading, and they went under as well. So this is something that we've seen time and time again in crypto,
Yes.
where large players do go under. What can people do to make sure that they're picking safe platforms, besides, of course, using CoinFLEX? What can people do to make sure that they're picking safe platforms to be investing on?
Yeah. So one of them, especially for people who like earning yield, is you want to pick a platform where the interest earning activity and the payouts are matched. So I'll give you an example. What you wouldn't want to invest in is someone who's saying we're going to pay 19% regardless of how much we're making on the interest earning side, even if that's 6% or 1%. And that's functionally effectively what UST was. It was a platform that said decentralized, somewhat decentralized platform that said we're going to pay 19%, but we're only going to make. I think they were making 6% on a small percentage of funds, so in actuality, it was 1%, and that's unsustainable. There's paying 19, making 1 doesn't work out. So, and really, this applies even if the number's 19, or even if the number's 3 or 8 or something. Anything where they're guaranteeing a fixed rate of interest is risky, because they may not be able to make that fixed rate of interest. What they should really be doing is saying, this is what we're doing. We're going to give you the return from this activity. The return right now is this. In the future, it might be different. Here's all the situations that can happen. And then you can say, oh, I'll look at the track record and I'll invest in it. So obviously FlexUSD is an example of this, but Compound, Aave, most DeFi lending protocols function this way. I believe there's probably some other centralized players. I'm not aware of many of them, or I don't think I know of a lot of other centralized players that do this. But everything in DeFi does this for the most part. The biggest platforms certainly do. Compound and Aave certainly do. So Curve is a similar one. You can put in stable coins and they'll make markets. Your stable coins will be providing liquidity to people that want to trade between different stable coins. And you're just earning the trading fees based reward. And they're not guaranteeing that the reward is going to be anything. They're just guaranteeing that this is what's happening in the back end. And if the volumes are really high, you're going to make more money. And if the volumes are lower, you're going to make less money. So I like products like that where we call it kind of an economic cleanness to it, where the inputs on the back end where the money is being made and the payout end of where the money is being paid out are evenly matched. In that type of product, the business is much, much safer. Whether it's a centralized business or a decentralized business, it's going to be much, much safer.
Well, the difference really is when you look at sites where they're saying, hey, we'll pay you out at, let's just say it's 5% or 3% or 9%, or it's varied all over the place. What they're really doing is they're taking your money and they're using a variety of tactics to make money, and then they're pocketing the difference between what they're paying the users and the overall yield of their strategies. But when those strategies start to go awry, for example, you have smart contract problems. I think Celsius early on had a big smart contract issue where they lost a bunch of money in a Badger hack. So you start to lose money there that has to come from somewhere. Or when you start to have less loan opportunities where you can sort of pocket the difference, that that will come at cost. So they're essentially, this dries up the opportunities for them to make money, and then you could end up sort of having some solvency issues. A couple more comments here on the overall market I want to make before we get into some of the stablecoin specific stuff. I was talking with one of my traditional finance friends. He's a trader. He doesn't really do crypto stuff. And we were talking about specifically, was the Celsius position getting hunted, or maybe even the 3AC position getting hunted, where they know that they have to liquidate, and they know that if they put pressure as these assets move downwards, they have to sell more. And so you could put on massive shorts and then force these guys to sell. His thoughts were that something like that is impossible really in traditional finance. I mean, maybe there are some really fringe examples where you can get short squeezes and things like that, but overall the market as a whole is too big to cause that kind of movement. What's your thought about in crypto? Is it possible to do something like that? Because if we just think about the amount of assets that has to be sold to put this kind of downward movement, is it possible that this was a coordinated attack on these positions of these firms, or do you think this is just more based around the kind of classic crypto leverage situation plus the Luna implosion plus the general market situation?
Yeah, so let's talk about that. So, I mean, Ethereum and Bitcoin are enormous assets. It would take a lot of capital to make that type of I'm gonna try to hunt a Bitcoin liquidation price or an Ethereum liquidation price. That being said, we're not just talking about Bitcoin and Ethereum here. There's also staked ETH, Steth, and you can hunt that liquidation in a way where you're not even taking price risk on Ethereum. So if you can borrow a large amount of Ethereum, mint it into STETH, and then just dump it at prices below you minted it at. Now, what you really want to do is, I suppose, what you would really want to do is borrow STETH. So sorry about that. Borrow STETH, sell it for ETH, and then you're basically betting on a collapse of that spread between STETH and ETH. So let's say that spread right now is 0.95, and you think someone's going to get liquidated at 0.9. And then you'll be able to have the chance to buy back your short at 0.8. That's a decent opportunity because at 0.95, your max loss is really 5% or a little over 5%. So, it could go to 1. It's not going above 1, right? But your max gain is, I mean, depending on how little buyers of STETH there are, it could go to 0.6 or 0.5 or something. And I'm not saying it's ever going to do that, but the point is, in a liquidity crisis, not a lot of people want to lock up their funds for a while. And so that's the problem with something like this is not the Bitcoin positions. Those could get hunted too. And there's some pretty large players in crypto now. There's some very large hedge funds that are now in crypto. So the idea of them putting on a $5 or $10 billion short, it's not impossible. I don't think we've seen it. I think we would have seen that in the open interest numbers on different futures exchanges. We would have seen it in borrowing rates on different lending platforms. We would have seen it in either of those two mechanisms, and we didn't. So I think we didn't see a hunt in the actual instruments themselves. That being said, I think you have the equivalent of somewhat of a decentralized hunt, where if everyone is looking at the liquidation price and then thinking about buying Bitcoin, they're probably also waiting to see whether those liquidation prices are hit before they buy Bitcoin. So you have a bunch of retail users that are all on Twitter that are thinking about potentially buying Bitcoin, but they see a liquidation price at 18K, and they say, well, I don't want to be the sucker that buys at 20K before it inevitably goes to 18K. So this kind of, the meme of the market going to a liquidation price gets in people's heads. And when that meme gets in people's heads, it's very difficult for them to make buying decisions. And sometimes they make panic selling decisions. And so in a way, it's a form of decentralized liquidation hunting, effectively.
Are there any large known positions that have certain liquidation points like that? I've heard a lot of just rumors and talk about MicroStrategy in general, although it seems like they're probably fine because they're not overly collateralized in their Bitcoin position. Are there any publicly known positions that are currently causing this sort of waiting game for people to wait for the price to drop?
Yeah, I don't know about right this moment, but in the last 24 hours, there have definitely been a lot of positions that are on Aave and Compound, where you can see the liquidation price. You can see an Ethereum address, you can see its loans, and you can see the liquidation price of those loans. You can see the exact price updated in real time. And oftentimes these addresses are actually tagged. So if they belong to a 3 Arrows, or they belong to a Celsius, or they belong to any of these folks, the entire public, the entire investing public can actually see that. They might not have certainty as to whether it really is one of these entities' addresses, but maybe they can have 95% certainty or something. And so, but it almost doesn't matter who it belongs to. At the end of the day, the position is real. Whether they can top up is the big question, and it's real risk. If it does go to that level, then it will get sold. So or they'll have to top up collateral. So yeah, these things are very, very public, and this is in a way, this is the downside of using leverage on DeFi, because if you use leverage on a futures exchange like CoinFLEX or BitMEX or Binance or FTX or any of these futures exchanges, like no one will see your liquidation price. That information will be very, very private, very, very much not public information. And it shouldn't be public information. But in a DeFi ecosystem, the upside you have is transparency, massive upside. The downside you have is transparency. As a leveraged user, you're also dealing with transparency. And sometimes that's good for you, but sometimes it's really, really not good for you. So
The transparency aspect of crypto, it really is a double-edged sword, because we think about all of these benefits about, being able to verify things on chain and know where every single coin came from. But then you can verify every transaction on chain and know where every coin came from. And unless you're going to use sort of advanced techniques in order to disguise your coins, then people can track your history, and it
yep.
just takes sort of one transaction to be able to find a long line of them. So certainly some pros and cons there. I wanted to ask a question on staked ETH, because I think that topic has come up a lot lately as well. What are your thoughts on staked ETH as a concept? And I guess the real question on a lot of people's minds is Ethereum actually going to meet their timelines to be able to pull off ETH 2.0 or whatever we're going to call it now? I know there's been a little bit of a move away from 2.0 branding. What are your thoughts? The merge, exactly. Yeah. What are your thoughts on the timeline for staked ETH and just staked ETH in general?
Yeah, a lot of people think that this crash will change the timelines for the merge or 2.0. I don't see why that would make any sense. I think it's still likely going to be the same time frame. The powerful thing about staked ETH is a few things. It requires 32 ETH to be a validator post the merge and on, I believe right now, the Beacon chain. That's a lot of money. Most people don't have enough money to buy 32 Ethereum. So staked ETH allows for staking to be more democratized. It's a DAO. It's called Lido DAO that enables anyone with any amount of Ethereum to come in and basically participate. So that's really cool. The dangerous thing is when people view it as one-to-one with Ethereum. So for a while, it was one-to-one with Ethereum. It would get created and sometimes sold, but at the end of the day, it would trade within a very, very narrow band of one-to-one. And the problem is, in the case of a stablecoin, you have Tether. When you have Tether and USDC and FlexUSD, you can go to these companies and say, "Hey, give me my dollars," and they'll say, "Hey, here's your dollars," and they'll wire you a bunch of money or send you a bunch of dollars, and that's great. But with STETH, you can't just do that until after the merge, and so it is really a very long-term instrument. And ironically, anytime interest rates rise, which is what's happened with the Fed, longer-term maturity instruments go down in price. So STETH is actually mirroring and mimicking what's happening with 2-year treasuries, 10-year treasuries, any type of long-term instruments. 10-year treasuries are very safe if you hold them for 10 years. If you buy them when interest rates are low and you have to sell them when interest rates go higher, you're almost guaranteed to lose lose some of your money, but you could even lose 10% of your money doing that. And so it's the same type of dynamic. If the US government is not going to default on a 10-year treasury, Lido DAO, as long as the smart contract works, will not default on STETH. But you can't get the dollars back from your treasury or the ETH back from your STETH until the expiry of the thing, until the 10 years in this case of the treasury, or until after the merge in the case of STETH. So that's what's happening here. There's a price for liquidity, and that's why this large discount is widening.
If you're a longer term Ethereum bull, then it would seem to make sense that as the discount rises, this is a pretty good opportunity for you to buy Ethereum at a discount.
Yeah, for sure. It's a great price opportunity. If you want to, and I think there's a number of them out there. So futures are in backwardation. So what that means is futures are trading below spot. If you want to buy Ethereum and you're a long-term Ethereum bull, you can look at buying longer dated Ethereum futures. You can look at buying STETH. You can look at buying ETH products, which is by the Grayscale company. Those have a management fees and they don't have a redemption ever. So there's probably more risk there. But generally speaking, you can buy a lot of different products that will help you get your exposure to ETH, and they'll also, on top of that, get you, a pricing discount for the fact that markets are very, very illiquid right now.
Sounds good. On that note, we have more exciting topics to talk about. But first, have I mentioned the giveaway? It's time to check in on our monthly FlexUSD $100,000 bankroll challenge. FlexUSD is the world's only interest-earning stablecoin which pays interest right into your wallet 3 times a day. We are currently tracking 100,000 of FlexUSD over the year to see where it ends up and are giving all of that interest earned to you, the listeners. I've got some good news. I was going through and looking at the entrants on this podcast, and so far we've had no entries. So if this stayed consistent, you would win just by sending out a single tweet to me using hashtag FlexUSD. In the last week, FlexUSD has been averaging 5% APY, and CoinFLEX has paid out over $28 million to holders in general. This week, we have made $412, and we had 200 and something the week before, bringing the total to $700. Comment below, or rather tweet at me at Doug Polk vids using hashtag FlexUSD to be one of the 10 people to earn $700. Legal disclaimer: none of the information contained here constitutes an offer to buy or sell any currency, product, or financial instrument, or to make any investment or to participate in any particular trading strategy. Still working on the fine tuning of the timing there.
Yeah, it's a lot,
but we almost got it in there. It's also possible that we have had a bunch of entries. I just don't know how to use social media. So head on over to Twitter, guys, at Doug Polk vids using hashtag FlexUSD to win your chance at $700, and that interest, it's only going to be going up.
Yeah.
All right, back into some topics. Let's get into the downfall of Luna UST. Maybe we'll start up with an overview if you want to break down the story to us.
Yeah, so Luna was a very interestingly designed stablecoin. The design mechanism was effectively, or UST was an interestingly designed stablecoin. The design mechanism was effectively that in order to mint units of UST, the stablecoin, you had to buy units of the volatile asset, which is Luna. And you would buy Luna, you would then convert it into UST through a minting and burning process. And what that would do would be it would burn Luna. So you would, if you're buying $1 million of UST, you're actually buying Luna first, burning it, and that reduces the supply of Luna. So that's good for the price, right? Because you're buying from sellers on the order book, and you're not just holding it to sell it later, but you're actually buying it to destroy it. Hopefully forever, but actually not forever. So that then mints UST. The problem scenario was to redeem it, you would go the other way. So you would burn your units of UST, get Luna, $1 worth per dollar you burn, at whatever the price of Luna was. So if the price right now is $100 and then it went down to $10, burning it at $10 will create burning UST at $10 will create much more Luna than at $100. $100, very little will get burned. At $10, a lot will get burned. And so this enabled a redeemer to then sell that Luna and get back into cash. Now there's some problems here, which is that Luna is not infinitely liquid. So if I have $100, I can burn UST and get into Luna and then sell $100 of Luna, and I'm probably going to get $99.5. But if I have $1 billion and and I want to sell that in first by burning UST and then by selling Luna, if I have $1 billion, I'm probably not going to get anywhere close to $1. I might get 98 cents, 96 cents, 95 cents. And I'm talking about scenarios where the peg is strong. Just the fact that Luna has slippage. Luna was and still is, I guess, a volatile asset. So even when the peg was strong, if you redeem out of UST, you're still going to pay some price. It might be 1%, 2%, 5%, whatever. You're still going to pay some price. Now, people were happy with this slippage on the way in and out because Luna at the time was very liquid. It was typically going up. So you felt like, oh, I can redeem and maybe make money. I get the Luna. It goes up for a day. I sell out. I've made money from cashing out of my UST. But it was an extremely risky stablecoin because there was nothing that was worth $1 backing the stablecoin. In fact, there was really nothing at all backing it. It was basically backed by the hope that there would be liquidity in Luna. And really, it was really built on the assumed premise of infinite Luna liquidity. So it would work if the Luna liquidity was infinite. If it was anything less than infinite, if it was finite, it braked. It broke. It was destined to break.
It's early.
What?
I said it's early. He said it braked. I was just joking.
It's
early in the morning today.
It's early in the morning. For the listeners' context, I'm in New York, so I'm not in my usual time zone, and it's quite early for me. But we're here with you guys. So yeah, that was how the stablecoin was designed. It was designed in such a way where, in the periods of mass creations, Luna would get bought and then destroyed very, very aggressively, extremely aggressively. And so Luna had this massive price rise. Went from I think 30 cents to $100 in a very short period of time. A 300x return. And the problem was that the people that were minting UST, and a lot of them were institutions, they didn't think deeply enough about the scenario where you're going to get a few redemptions. And they didn't think about how even just 5% or 2% of the supply being redeemed would cause a depeg. And that depeg could cause fear, which could cause another 10% of the supply to get redeemed, which could cause a catastrophic depeg. Because Luna really wasn't, when I say 10%, I'm talking about $2 billion. The supply of UST got to 18 billion. Well, 10%, $2 billion, Luna never had anywhere near the liquidity to handle that in any meaningful capacity. So that was always going to have a destructive effect to the Luna price and to the UST price. So yeah, it collapsed. It was very obvious it was going to collapse to most people that were looking deeply at it, but to a lot of the institutions that held large quantities of it, businesses, institutions, high net worth individuals, billionaires, etc. They didn't understand this redemption scenario well enough, or they thought that Luna would be constantly more liquid than it was.
Well, it's also one of those situations where if you have that type of money invested in an asset, you should probably be doing some, any kind of research on the asset that you're holding, because it was not exactly a secret that this was very Ponzi-esque, if not just an outright Ponzi, depending on how you want to word this exactly. Yes. And on my crypto channel, I posted a video a month before it went under saying, guys, don't invest in UST. Don't invest in this process. There's a problem. This doesn't work. There's reasons why this doesn't work. And I don't think that's some crazy insight on my part where I was able to see that it wasn't a beautiful mind where I was just like, figuring out it was pretty clearly a Ponzi, and it was obviously going to work while things were going up. And the moment that there was real serious turmoil, it would break. And there were some smart people who made a lot of money shorting it on the way down, which brings us into our next point, because I wanted to quote something that you said on a recent podcast, where you said, quote, if anything, this demonstrates the importance of shorting. There are people who are short Luna and USD, and we're talking about this stuff. If there wasn't this profit motive to cause this, and earlier I miswrote this, but basically, can you talk about shorting, the importance of shorting, and maybe why shorting was a good thing in this particular instance?
Yeah, sure. So I think shorting is really important as a feature of markets to kind of correct prices and to help prices of overblown assets, kind of to protect them from getting more overblown. So, but especially it's important in markets self-policing themselves. There was no regulator that was really going to step in to something like UST. It was extremely complicated. It was based in multiple jurisdictions, and it was relatively decentralized. It was somewhat decentralized. So I think a lot of regulators, and regulators generally speaking, are they'll act after a crash and punish rather than getting involved in something that's already underway. And so what you had happen here is basically market actors said, look, this is a Ponzi scheme. This is a scam. I'm going to profit off of that. It started with some very famous bets between GCR and Algode against Do Kwon, the founder of Luna. And basically those bets were, if Luna is above 88, I will pay you $10 million or $1 million in the cases of GCR and Algode. And if it's less, then you'll pay me that money. And so that was a very simple bet. That was just a Luna price directional bet. And then you see more people starting to place the same bet, but in futures markets. So you see people shorting Luna futures contracts. And then you see people doing the safer version, which is people shorting UST futures contracts and shorting UST in various ways. And I say safer because really UST is not going to $2. So, there's if you're shorting a stable coin, there's a limit to how high it's going to go. But it could go all the way, and it did go all the way to zero, basically. So there's no limit to how low it can go. So you have this opposite dynamic with stocks, where it's risky to short stocks because they can go to infinity, and the upside is limited because it can only go to zero. Shorting stablecoins has always been attractive to people because the downside is, especially if you get in around one, if you get in 99 cents, 98 cents, your downside is really limited. You can lose 1 or 2 cents per dollar invested. But your upside is not infinity, but it could be the whole thing, right? You could double your money, or if you have leverage, you could make a lot more than doubling your money. So shorting is very attractive for stablecoins. And I think you started to see this with the Luna shorts, and then you started seeing it with the UST shorts. And then once a lot of credible people had a short interest, they also had a bigger interest in talking about it. And at first, they're going to be scared to talk about it because they're scared of getting stop hunted. They're also scared of getting egg on their face. They short Luna at 80 and it goes to 200. It's really embarrassing as a trader, right? But as they start to have some success and some of the cracks start getting shown in the Luna and UST ecosystem, I think a lot of these people got a lot more confident and brazen, and they would be making their positions known more publicly, and they would also be making their skepticism and their just disbelief in the system a lot more public. And that disbelief is reflexive, because the more the market doesn't believe it's going to work, the less it actually works. So the system actually functioned on belief, and when belief dried up, it just collapsed.
Going back to the value of shorting in price discovery and in preventing assets becoming overblown, maybe someone would argue the other side of that, which is if an asset is unpopular, or like we think about this in the actual stock market, if a company is unpopular, or they have unpopular views, or they have all kinds of different things that make people unhappy with them or unhappy with the project, it can act as sort of like a downward pressure that's unfair to that institution. So like, for example, I know Elon Musk for years was always battling the people that were short selling Tesla, and he's made a lot of comments about shorting, and he doesn't feel like, shorting
Yeah.
is ethical in a lot of ways. What would your thoughts be on the pushback on that side of the equation when it comes to shorting?
Well, he's absolutely right in that if you are shorting someone that isn't a Ponzi, isn't a scam, isn't a fraud, but is just someone who believes in the future, and they're doing everything they can do to make that future a reality, aka Elon, it is an incredibly skeptical view of humanity. If someone is shorting a Ponzi scheme like UST and Luna, um, they are probably doing some moral good, because they may have helped, especially if their shorting activity actually helped the thing collapse, or kind of assisted in the hastening of the collapse. There's an argument that rather than UST getting to 18 billion, it could have gotten to 200 billion, and without the presence of interested parties, capitalistically, profit motively interested parties that were motivated by the thing going down in price, you might not have had as much attention brought to bear in the crypto community. If I'm trying to publicize the reasons why something is bad, I'm going to get hated, and it takes a lot for me to tolerate that hatred, right? So if you're a trader or a crypto Twitter user or something like that, but if you have a short position on, you can tolerate that pain, you can tolerate that embarrassment, you can be the first one to stick your neck out, because if you have a short position on, you can profit from it. And so that's where I think shorting scams is good. But I think also, if you're shorting an entrepreneur like Elon because you think that his stock price is just overvalued, one, you're doing something that's very dangerous, because the reason that high multiple exists or that high price exists is because people believe in him so much, and he has a probably one of the best entrepreneurial track records in the world. I mean, he's built just the sheer number of companies he's built with so much success. It's incredible. And so you're doing something that is both dangerous and it's a skeptical of humanity type of approach. And it's especially skeptical of specifically one of the best, entrepreneurs in our generation. And so that's the downside. That's, I think, the negative about something like that. But the positive about shorting in general is that it does make markets more efficient. And that's a beautiful thing.
Makes sense to me. Going back into sort of the UST situation, how can we do a better job of educating the public when it comes to not falling for these what seem to be somewhat obvious scams? I think of the most notorious one beforehand was BitConnect. That one was a very obvious scam where it said, hey, we're going to pay you out 2% a day because we have this mystical trading bot, and just believe us, guys. And this was a lot more complex, and it had some real aspects to it, sort of mixed in with the Ponzi elements to make it a little more disguised.
Yeah.
And I imagine in the future, the next wave is always more complex than the prior one. We're not going to see this exact setup again, but we will see something that adds in some new layers and some new novelties that make it difficult for people to understand what's happening. How can we do a better job of educating the public when it comes to what is happening with these things and why they're legitimate? And the best example of this is with Flex USD, on a legitimate source of making money. I've had countless conversations with people about CoinFLEX's stablecoin where they ask, well, how is it not just a Ponzi? Where's that money coming from? Well, what's going on with that? Why can you trust stablecoins? Look what happened to UST. So how do we do a good job of educating the public on specifically what makes certain things okay and certain things not okay, when to a lot of people it all looks like the exact same thing?
Yeah, I think this is where probably more people than should have invested in stablecoins, and the market education is not as sophisticated as it could be. I think in a way you can blame short sellers because they didn't act early enough and they let the market situation get to the degree to which it had gotten to. But at the end of the day, it's a combination of the people who invested, should not have made that play. And then also, I think the educators in crypto should have been more vocal. And so this is what we're trying to do with FlexUSD. It's fully collateralized. It's fully collateralized by both crypto assets. It's buying Bitcoin and crypto, and it's also shorting futures contracts. The FlexUSD portfolio is shorting futures contracts against that investment. And so at any price, FlexUSD is always backed by $1 worth of collateral. And that's an important thing for anyone to think about with respect to any stablecoin. You have to think about, okay, what is this actually backed by? And if I don't understand that, I should not own this stablecoin. It's a relationship that you have to understand. And if it's not transparent, if I can't see it, if I can't figure out the backing, I'm not going to use it. So that was the issue with Luna, is I think a lot of people didn't understand how being backed by a volatile asset when your liabilities, you're a stable asset, is a problem. And in a bull market, it's not a problem. In a questionable market, it becomes a bit of a problem. And in a market that starts to even merely look like it could be a bear market, that becomes a collapse problem. So I think you want to figure out what's the backing. And we're extremely transparent about that. You can go to any of our different websites and just look and see the exact backing of FlexUSD and see exactly how the thing functions. USDC does a good job at this as well, but there's a lot of stable coins where people just really don't, they don't know what it's backed by, and I think those should be avoided at all costs.
Well, so the other part of this too, and of course we do this podcast live, so we have some commenters in the chat. We have people like Wes Ismay, who says fully collateralized by quote crypto assets end quote. Yikes. So how do we explain to people like Wes Ismay that if a coin, so FlexUSD is fully collateralized, but it is collateralized by a cryptocurrency, USDC. What makes that? How can that be okay? And I know that might be something where half of the people in the chat are like, okay, we understand why that's okay. But there are a lot of these people out there in the real world who think if it's a crypto, it's risky. If it's a stable coin, that means it can go to zero. How do we convince them of the underlying collateral being okay despite it being a cryptocurrency?
Yeah, so I think it's about convincing people about the structure. It's not, we're not just YOLOing it and buying Bitcoin. We're buying Bitcoin and selling futures at the same time. So it's really a lending transaction into the futures market. And so if there's $100 million of FlexUSD, we're lending out maybe 80 million of those dollars into the futures market by buying repo, which is effectively buying spot and selling futures at the same time. And so when you do those two transactions, and Bitcoin goes down 90%, you have no Bitcoin exposure as FlexUSD because your short position would have gone up a bunch. You would have made a lot of money on your short position, and your spot Bitcoin would have lost a lot of money. And the combination of those two things equals you're okay at any price. You're fully collateralized at any price per Bitcoin. And that's a powerful concept that we're trying to instill in people is, look, you can own a stablecoin in your ERC20 wallet or your Ledger wallet or MetaMask or on a CoinFLEX account and also earn interest. So you can own FlexUSD and also earn interest on it, just natively owning the token. And this is not something that's true with USDC. It's not something that's true with Tether. But it's also possible to pay that interest without being severely risky. We can have these interest payments be made without the system actually being destined to collapse. The system is solvent at any price. It is fully collateralized. And when you account the overall collateral in the CoinFLEX ecosystem, it's really over collateralized. So it's a very, very powerful combination. But yeah, it's going to be confusing for people. We're going to have to do a lot of education.
Certainly no way around that. And I think a big part of it too is the people have to want to actually try and learn something.
Yeah.
I do feel a little bit, and it's the elephant in the room that has to be said. I do feel a little bit for the people that aren't into cryptocurrency, and they just have to suffer through years of people telling them to have fun staying poor, and the memes everywhere over and over again. And then
So unhealthy.
crypto drops, 60-70% of its total value. And then everyone says, have a little decency. There are people going through tough times. And then these people are like, yeah, fuck you. There's a bunch of that going on for sure. I do wonder how much of it is people end up in these tribes. Either they are for crypto because they probably own some, or they're anti-crypto and it's because they didn't get on the boat. And I wonder if there is some way where these things can sort of live in a world more together, or these people can live in a world more together where there's an easier onboarding for some of the non-crypto people into crypto assets. But I do feel a little bit like crypto has a Trumpian quality about it, where you get to a point with crypto where you're either I'm for it or I'm against it. And I don't even fucking care what people have to say. I'm either for it or I'm against it. What do you think about how people have really had to, draw a line in the sand? Do you think that there's a lot of adoption still yet to be had by the people that are on the side against cryptocurrency? Or do you think it might be a little bit too much for some of those people, and really it's more a question of over time young people sort of taking the place of the older generation?
Yeah, so what you're kind of discussing and kind of getting to is the crypto adoption cycle a 10-year cycle where we can convince everyone, including people that are around today and maybe much older today, or is it a 50-year cycle or a 30-year cycle? And it's a great question. I like to think that it's probably closer to a 10-year cycle, because I've seen so many people that are, in their 60s become crypto experts, and even some of the largest owners of crypto that I know personally are in their 60s and beyond. And so I think with the motivation, anyone can do it. It's just a question of motivation. And so really, for every company, there's an efficiency for using stablecoins, and there's an efficiency for using, something like a FlexUSD or any type of stablecoin where your capital is going to move around the world faster. For anyone who's looking to protect their money from inflation, there is this monetary inflation benefit to crypto, which is how much is going to get printed every year. You don't know the price. You might be toast on. If we've seen huge drawdowns in crypto this year, right? But the monetary supply is the most consistent monetary supply out of any currency in the world. That's extremely attractive to people. It's extremely attractive to people in hyperinflationary, countries. So the question is really, we have to think about, why is the price so volatile? Why does crypto move around so much? Well, it's because hardly anyone's using it. And I say this as someone who's been in crypto for 9 years. Hardly anyone's using it. If the world economy was 5% transacted in crypto, so crypto for payments, crypto for transactions, crypto for different types of economic things, we would see way less price volatility, because crypto is 0.5% of the world's money supply. So right now, Bitcoin, Ethereum are roughly 0.5% of the world's money supply of 100 trillion, 0.5% to sometimes 1%, right? So if there was if you had similar percentage of actual usage in the world economy for payments for goods and services and these types of things, then the euro versus the dollar is very stable. It does have moves, and in long time periods, it has large directional moves, but they're not that large. There may be maybe 5% a year, sometimes 10% a year. On a daily basis, they're very consistently way less than 1% a day. And so you have a stability of those currencies because everyone's using them to buy groceries, buy all sorts of things, to trade with multinational corporations. If people were doing this with crypto, then the end result would be that stability, and the other result would be people that were of an advanced age, older people would have an easier time learning about it, because the biggest thing that people that aren't interested in investing in crypto ask is, well, what can I buy with it? And for most people, they're not investors. Most people actually live paycheck to paycheck. They live month to month. So they're not thinking about, can I buy this and then it goes up in value? Like, irrelevant to them. They're going to spend 90% of what they make this month. So that's the situation that the vast majority of the world is in. And because that's the situation for the vast majority of the world, some sort of speculative aspect of crypto is irrelevant. So what they care about is whether it can be used for payments and for other things like that.
Right, and for financial sovereignty, which is one of the main reasons I got in it to begin with. As a poker player, banks suck. They take your money. They won't pay you out. It's frozen during the weekends. Having the ability to say, hey, this is my money. I control it. I can send it. It's just me, is incredibly powerful, and really is the underlying, I think, single strongest aspect to it. I mean, there's a lot of strong aspects to it overall.
I agree with you.
Going back to talking about the older generation, it's really tough, Mark, because I think so. There's an older person that is close to me that I was telling a lot about Bitcoin 8 years ago or so, and I was saying, trust me, like, I really believe this is going somewhere. I've invested a bunch in this. It was about $500 at the time, and they believed in me, and they decided to buy 10 Bitcoin at $500, and so they bought it, and they just never really figured out how it really worked. And it was on exchange, and they didn't find the most reputable exchange, and they never figured out how to get it onto a hardware wallet, and they ended up essentially getting scammed, where the exchange went under, never heard from anyone again, lost their $5,000 that they invested at 500 in Bitcoin. And I think back to that, and I think, wow, I mean, obviously that was a great buy, but is it too much to ask for older people, especially people in their 60s, 70s, 80s, to get involved in this industry where it is so easy to get scammed? So easy. Can in good faith, can we really advocate for these people to even get involved if they're not going to know how to store it? They're not going to know how to keep their computer safe. They're not going to know how to send addresses correctly. They're not going to know how the internet works quite fully. What do you think about that?
That's just the nature of finance, where the barrier to entry is very low to compete in finance. And, for a long time, finance has gotten more and more regulated, especially in America and other countries in the West. And so finance being more regulated has meant that basically, for all the interesting financial products, they're really only accessible by the 1% or even the 0.1% of wealthiest individuals, institutions, etc. And the problem with that is a lot of those opportunities are how you get rich, or how you can go from lower level on the socioeconomic layer and have a lot of mobility and create generational wealth for yourself. The problem with opening up the financial toolbox to anyone being able to innovate is it's a double-edged sword. On the upside, anyone can create really, really interesting financial products. On the downside, anyone can scam. The cost to scamming and the risk to scamming go way, way down. And that's horrible. It's truly horrible. We need to improve our market-based measures of preventing these guys from doing this, because the government isn't doing enough. They're not preventing these scams in a meaningful enough capacity that it's working. So people continue to be scammed. There's obviously enough players now in crypto that are very, very trusted, the Coinbases of the world, etc., where you're not going to lose your money. You've got a margin of safety there. You've got a lot of safety there. But the problem is ultimately that, that new person doesn't necessarily know the difference between a Coinbase and a site that also looks well designed, but is a scam. So it's very easy to see with bank branches, which banks are, have branches everywhere in the physical world. It's harder to see that when you're just going into Google and typing in buy Bitcoin. And it's especially hard to see that if you're an older person that doesn't know some of the telltale signs of one of these companies that might be a scam. So that's the hard thing about crypto adoption. I think that will get better over time. The good thing is some of these companies are now absolutely enormous and can display and market their size in ways that engenders trust and engenders credibility. But yeah, this is a problem we're going to continue to deal with.
Well, a nice somber note to end the podcast on there. We didn't actually talk too much stablecoin stuff, but we actually have to run over to a Discord AMA we're doing over on the CoinFLEX server. If you guys want to come check that out, Mark and I will be hopping onto that. I want to thank Mark. Thank you for joining us today for the pod.
Thank you so much. Thanks for having me.
Next time we'll do it at a reasonable hour.
Sounds good.
All right, guys. Thank you for tuning in. We're going to be back next week. Eric Person joins the podcast. We're going to talk about all of his antics with Phil Hellmuth. Also a little bit about owning card rooms, a fellow card room owner, plenty to talk about there over on the poker side of things. We'll be back next week, the 20th. I'll see you then.